What have I told you since the first day you stepped into my office? There are three ways to make a living in this business: be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.
Here we go, and welcome back, y'all, for another weekly market recap. It is Saturday morning. It's relatively early for me, being a weekend, and you may be able to tell by my voice. I just noticed that it starts out pretty raspy and pretty nasal, and then throughout the recording, while I keep talking and my vocal cords start to warm up, it becomes a bit more, I guess, normal or bearable, maybe. It depends on you, I guess. But this is it. Now, what a week it was. Pretty eventful, gotta say. Although, again, from the economic calendar standpoint, not a lot. We are going to look at it in a minute. But as a quick overture, just to fit the current sentiment and pace of the market, it looks like we are back in a bear market. I mean, it's standing to the news, right? Or what I read recently. The market came down broadly. I mean, different asset classes came down. We still see problems in the credit market with the subprime auto loans, the repo market, which spiked last week. It's cooling off a little bit now, but still people are a little bit on the high watch for that. So liquidity issues, collateral being questioned. And then we got two hedge funds being shut down by UBS. I guess that was a big thing for the week. Not major systemically, but, you know, in the context of this week and this month alone, maybe a little bit. What else? Just a quick overture on the top of my head. We have been talking about the concentration and the breadth problem of the market. We have been talking about the shutdown, which is the reason why we don't get official data yet. And I guess there is another reason why it might be a problem for the market. We are going to look at it in a minute when we're looking at the economic calendar. And on top of it, just to finish it up, what's the main narrative for this pullback overall at the AI trade, which is again finished, it's done, never gonna come back again? Yeah, of course. So all the things you can think of, and I forgot a few of them, but without further ado, let's just try to tackle them one by one at the best of our abilities, and bearing in mind the time constraints. So let's jump into the economic calendar. So ISM manufacturing PMI, they came out still negative territory because 48.7, which is actually down from 49.1 in September. But what matters is that we are still below 50. And being this a diffusion index, if you are below 50, you are still in contraction. And same could be said for the employment segment of this data release point, which is still, again, below 50 and not looking good. Now, I think when it comes down to it, you might want to dig a little bit deeper just for the sake of it. So yeah, it indicates contraction, of course, but just, reading the few first lines in here, you see that it's not that reliable, or at least it's not that accurate, because it's just a question, a survey about a few things. And, the main topic is, are they better, equal, or worse compared to last time you were interviewed? But it doesn't really tell a lot as for the actual data or the current month-over-month variation. So yeah, take it as you like it, but you need to be mindful and realize the actual range of this data and the actual efficacy or whatever the fuck of this data when you try to grasp something out of it. Overall, as you can see, not really cool, right? Still, again, indicating contraction. After that, we, of course, had the services part of the PMI, which is a bit better. It came up from 50 up to 52.4. And again, as I said in the past, back in those days when we were still looking at all these metrics, because we still had a government which was throwing out data, and contrary to now. But yeah, I mean, up until the point services are kind of holding up together, overall, the economy should be kind of cool, since again, services, they represent like 60-70% of the global economic output right now. Of course, that doesn't tell you a lot about, the different regions, the different sectors, and again, the K-shaped economy and all the rest. But I mean, at the end of the day, I think the market doesn't really care about the K-shaped economy. I mean, up until the point it does, of course, as for everything, right? Just a quick aside, the market may not care about the K-shaped economy. It's going to care when this K-shaped economy will bring consumers to pull back. If consumers pull back, what's going to happen? Less spending, therefore less revenues, therefore PE needs to be adjusted, therefore stocks prices need to be readjusted. But it is a process which sometimes takes a long time to play out. So you need to assess it week by week, month by month, or quarter by quarter, right? Hence why I said in the very short term, the market doesn't really care about the K-shaped economy. Actually, it looks like sometimes the worse the economy gets, the better the market responds, because of course there is that Pavlovian type of reflex where, if things are bad, the Fed or the government should intervene, pumping liquidity in, so buy, right? Now, after this tiny little tangent there, let's move on into what ADP. So ADP, as I said last week, it now releases a monthly statement or survey or report, and then they started to release weekly report. Now, this should be the monthly, if I'm not mistaken it, because it's talking about October versus September, as I can read, all right? It looks like we had a little bit of a bounce, nothing major, but still better than keep on losing jobs. Now, we have been talking about this lack of official data, but that doesn't mean that you cannot have unofficial data or alternative sources. Like, for instance, let's have a look at these. This is, I guess, this should be, I can't even read it anymore. This should still be ADP, right? Okay. So you can see the 3-month average and the monthly change, aka gains or losses. So it looks like, we are trying to rebound a little bit, although it's not spectacular, right? But again, it's still better than crashing like in here, right? Although, again, that was probably an outlier, 2020, with all the things which happened. But speaking of alternative data and sources, here you have Bank of America, basically. And they are comparing the estimates for payrolls to the BLS, to the ADP, and to themselves, basically. They are all saying kind of the same. The trend is down, so the labor market is weakening. But, first of all, you can see that there are discrepancies, although minor, in this data. But, again, the focal point is that if you don't have official BLS, NFP, you can still look at the other two. So the question might be, okay, so we didn't have the BLS, the blue line, for a while now, and the other two, they kept on going down. So what's going to happen when we finally have an official NFP release, when the government opens back up? Could this be something which ends up worrying the market even more? I guess we will see it only when we see it. But, it's just, again, another one of those risks to put on your whiteboard for the future, right? And be mindful of it, just to not be caught by surprise when you see the market all of a sudden tanking, and you might ask, okay, why? Oh, right. Yeah, that's it. Oh, that could be it. Or that could be one of the reasons why. Okay. Then we got these Revelio Labs, non-farm employment, month-over-month change. So they keep, this is just another, probably, I guess it is a private company, which keeps on tracking the non-farm employment. So the payrolls, the employment data and all the rest. And again, doesn't look particularly cool, right? So in the private sector, you see that we had that peak kind of at the end of the summer, and then it just drew back. And in blue, the government, of course, it's going down. It's been negative because, well, I mean, could be many different things. The most recent one, of course, is the shutdown, obviously. But you look at the previous candles, so the previous months, it was still in negative territory, which means that the government wasn't hiring anymore. But on net, it was getting rid of workers. Although, again, I keep on hearing that in the United States, it's very difficult to get rid of public workers, which to some degree, it resembles what I see in my own country, which is why we always had that old saying like, you would really like to have a public job. I mean, it's not because it pays you millions, but it's because it's safe. When you're in, unless you commit some serious crime or you fuck up big times, it's very hard. They're going to fire you, right? So maybe it's kind of the same in the US. I would take it as totally possible, absolutely, because of the bureaucracy, the red tape, and size of the government, which is going up and up and up in all the Western civilization. So why not? And here you have, again, another testimony, federal workers' unemployment claims, which, of course, they surged. Again, might just be because of the shutdown, but we'll see when these things is going to resolve itself, right? Then, again, still Revelio Labs. So here you have the official versus their own metrics. And it looks like they're kind of in line, although, I mean, for now. But if you check throughout the year, standing to this chart, at the very least, what they put out, right, it looks like the government was hugely overestimating jobs. Maybe not. There is always the discussion about the lag in the official data and the inaccuracy of the official data. We have been talking about it, 1 month ago, I guess. So pick your poison, or, I mean, have your own opinion, I guess. But sometimes it's hard to argue against these charts. And it's just something that we have seen for years and years and years. If you remember when we were talking about all the revisions and we were looking at that chart about NFP revisions getting back to, 2009 or something like it. So, I mean, again, it's nothing new, all right? So this would be it. I mean, we also had the Michigan consumer sentiment, which again is down, not surprisingly. And again, this is just something that ties in with the K-shaped economy. If the consumer feels so bad at a point, he's probably going to rein in spending. Oh, and now before we close, I just remember another thing from the beginning, the overture, which could be taken, at least from the sentiment standpoint, and then maybe even in practical terms, bearish, which is, of course, the amount of layoffs which have been announced, and a few of them actually implemented. So people are actually losing their jobs. I mean, the most famous, I guess, has been Amazon. But I mean, we have seen Intel, I guess it was, firing all these people which were in charge of the AI department development. So Meta, I guess Meta is firing a bunch of guys. They are trying to reduce costs. They're trying to cut costs. And what's the most immediate and quicker way to do that? Well, you cut heads, because you can really cut on your other input costs, like, I don't know, energy, rent, or the debt that you have taken on, and you have to pay it down, plus interest. So it's easier to just fire people. I guess, oftentimes on those news, you might see the market actually rallying because, less costs. It's going to boost up profit margins. Although in the long run, when you see a company which gets to the point where it needs to cut heads, or if you see many different companies which are laying off people, it's not good, because if you think about it, looking maybe more than one step ahead, what you need to see into the future is, okay, so if they are firing people, they might boost their revenues now, or they are going to protect their revenues and the profit margins now. But then, 6 months, 1 year, 2 years from now, we are going to have more consumers with no spending capabilities. So how do these companies think of making revenues in the future if those people which were supposed to buy the things, the stuff, the goods, the services that they are providing are not going to be able to have the money to spend on those services and goods, right? So, I mean, it's it is always some sort of a trade-off in between short-term relief for long-term misery, I guess. Now, the break-evens stayed relatively flat this week, maybe slightly down, but not huge changes. Going very swiftly here, PCE as measured by Truflation came down sharply compared to the top, to the up move we were looking at last week. And same for CPI, which came back around 2.5. Again, for a moment, the beginning of the week, it was actually at 2.7, so really close to the government and the headline CPI data that we had last week, I guess. But again, it came down a little bit. Now, you can see now how the trend kind of shifted. Now, this is a very short-term trend, of course, that they are calculating this daily, so who knows, right? But maybe we have a little bit of a inflation renaissance. Again, I don't think it's going to be massive because I don't see the economic backdrop for an inflationary period, but in the short term, would I be surprised to see inflation briefly getting back above 3.5, so to speak? Maybe it could be, right? But I'm still thinking that overall, over the long run, it's set to come down, right? Especially when one of the biggest component of it's going to come down, which is rent, all right? Now, GDP Now was updated on November the 6th, so on Thursday, 4%. Okay, we'll see. All right, we'll see. Credit spreads are still in a very, safe territory for now, especially when you zoom out like this, right? I mean, it's easy to get to the 1 year chart and saying, oh, they spiked. Yeah, I mean, they spiked in the context of these few months, right? But they didn't even come to the levels they were in April on the tariffs announcements. So, if you want to have your big market crashes, you need to see something like this in 2020. Although, again, that was some sort of a one-off, right? Under many different perspectives. But, your 15 to 25% corrections, you would be looking at something like 2019, which ironically, it's kind of the same time where we had another problem in the repo market with the repo blowout, right? Or, again, 2022, and the market was down. At the end of the day, it was down what? Peak to trough, it was what? 25%? And then actually rallied into the end of the year. And then, of course, you got the tariffs announcements. So, I mean, if you're not seeing these levels, let's say around 3 on this chart, on the Fred database, if you're not seeing around these levels, I would say it's not particularly worrying, right? Now, Fed Watch, it's still pricing in a 67% possibility of a cut in December. We will see. I guess, again, they are still discounting what Powell said. Another cut, it's not a far-gone conclusion and all the rest. We've been talking about it last week, so not going to repeat that. But, I think eventually they're going to cut, especially again, if this thing which is going on in the repo market and with the collateral and the liquidity issues, potentially, it keeps on escalating from here to the end of the month, because they're going to need to throw out the signal that, well, look, the Fed is here. We are trying to ease financial conditions as much as we can, and we are not letting this thing get in our head. We are actually trying to stay in front of it, right? So that would be it. Another thing might be, since we are here at this point, is that the current liquidity issues that we are seeing, they can have many different sources, of course. And I've always thought that the main one, it's counterparty risk, right? because when is that the lending activity stops? And therefore, since money is credit, when the money stops, it's when you have so much perceived risk in the system that people don't want to lend. They don't want to take the risk because they don't have the ability anymore to assess and to value the collateral fairly, since we are mostly living on a collateralized lending activity these days, right? And another factor might be that you need a third party which is constantly, pouring money into the economy. And who might be, you could ask? Well, of course, it's the government. If you look at what is the impact of the government in percentage terms on GDP, so it's almost 50% at this point. So with the government shut down, what you're going to have is that people kept on paying the taxes, right? Because strangely, the government is shut down, but they keep on collecting taxes, right? And therefore, you have the TGA skyrocketing recently. Now, I guess, when they open back up, this chart is going to reverse to the downside, because at that point, all that government spending will be unfrozen, right? And those money will just flow into the real economy. All the government programs, all the public employees' salaries and wages. So I think when this thing is resolved, we might see liquidity conditions improving just a little bit. I mean, we are talking almost $1 trillion, right? So it's really not peanuts, right? Especially in the very short term. So I guess it's very easy to be bearish just because, I don't know, Bitcoin was down, 10%. The stock market maybe was down 3-4% this week, something like it. Don't remember now. But again, these things are all kind of, fixable in the very short term at the very least. And then we'll see, right? Now, after all of that, let's instead have a look at the charts, because I realized this initial segment went on for quite a bit now, all right? Let's move on. Obviously, as any other week, we are going to look at the DXY first. Now, do you remember we were looking at this high and the assessment was, well, look, it might look like this is a strong move, but the key point would be this high. Now, so far, it looks like we just swept it. Now, I know for the price action purists out there, at least, if I get back with my memory to 4 or 5 years ago, I do remember that was that discussion. It is a sweep or it is a raid, and why it's one thing or the other. Yeah, because a sweep, it's just, the shadow of the candle, like a swing failure pattern. Maybe a raid, it's just like price trading and even closing candles above that previous level for a while and then actually coming back down. So more similar to a deviation, right? I mean, at this point, I don't really pay too much attention to those specific distinctions and terminologies and definitions, but I'm more interested in the practical side of things. Like, we try to breach above this high, we managed to close above it, and the very next day the market was rejected, and then it just accelerated to the downside. So far, I wouldn't really call it a decisive structural change. We still have the potential to come a bit down again, and maybe then kind of doing the same things we have done in here, right? Sharp move up, comes back down, reaccumulates, tries for another push higher. So wouldn't be surprising at all to see in the same type of pattern here, right? And, if it doesn't happen, so let's say the DXY ends up kind of, oh, TradingView just glitched on me. That was nice. Okay. Sometimes that it can happen. Right, so let's see if we see a DXY kind of failing here and getting back below, let's say, these lows, right? And then starting to go sideways in here. At that point, you might say, okay, we are still in the overall range. So here, right, your range lows, right? And your range high here, which would be now confirmed by this one. And you might see the dollar keep on staying relatively stable. which again, at the end of the day, if you think about it in the grand scheme of things, it would achieve two things. One, it would establish that it's not crashing anymore. So this thing about the loss of faith in the currency, it's not really a thing because, I mean, we have been flat for what? 4 or 5 months now. And on the other side, it would fit, I mean, at least politically or for PR type of goals, it would fit the narrative and the aims and the goals of the current administration, which, you know, they wanted a weaker dollar in order to boost exports. Now, whether that is working or not, it's a complete and whole other topic, because as we have seen from the ISM manufacturing PMI, it doesn't look like exports or domestic manufacturing is being boosted by any means, right? It might happen in the future. As I said, these structural changes, they cannot happen overnight. They cannot happen in a month, in a year, or whatever. It would probably take at least, I'm not one to exaggerate on purpose, but at least a decade, in my view. So it's totally possible that another 3 years, another administration comes in and it completely obliterates everything that the current one is trying to do and to achieve. But, you know, just for the sake of it, it would fit the current narrative of the government, right? So they might try to justify it. Well, yeah, I mean, that's what we wanted, so we got it. We were good, right? So overall, getting back to TA, I think, you know, it's still on the go for pushing a little bit higher in the coming weeks if it keeps on maintaining this structure, like higher highs, higher lows. And, you know, if it does it, as I said, efficiently and orderly, it's even better, because, you know, a spike is always bad in the DXY. You see a spike in the DXY, it's not cool for the overall market, especially risk on assets, obviously, right? Then let's try to have a look at these, comparing it to the euro and the other major currencies. I think TradingView glitched so much that every time I'm going to change the tab here, is going to reload all the charts, which would be annoying. I might post a video and just reload them all and then just, you know, keep on going. But let's first look at the euro, which went down a little bit more compared to Friday's close, but then middle of the week, it reversed. And of course, as usual, sharp move down, throws back in, as we've seen throughout this slow distribution down, right? Every time impulsive move down, throws back in. Impulsive, throws back in. Impulsive, throws back in. So this is how markets usually move, especially currency, right? Currency market, it tends to move like this unless, again, there is something big happening, a major central bank doing something or something else, or, you know, a currency crisis or whatever. But you need something really huge in either the macro landscape or the geopolitical environment to have sharp and huge and sustained moves in these assets right here, right? Now, the Canadian dollar, it's still the weaker of the pack, as usual. The dollar yen, which, you know, to fit the others, should be inverted like this. So dollar, it's still, well, I guess it was actually right first previously. So, okay. Yeah, because if it goes down, that's the yen weakening against the dollar. Yeah, it was right. Okay, so still nothing changed. A little bit of a bounce, but you know, the trend is still down. Swiss franc tried to bounce, but now it's going to be interesting to see if it can actually extend its bounce a little bit more and getting back, testing these apex right here, or if this previous shelf at this level, it's going to offer resistance now. Probably would be correlated to what the DXY does. And if you check, they are all having the same signature, right? From this one to this one to this one, all of them sharp move down, drawing back phase. That's all there is on currencies this week. Nothing more. Again, super annoying. You know what? Let me pause this. Holy shit. So should be fixed now. I hope so, at the very least. Otherwise, I'm gonna go through an autistic and outrageously rant. But tech tilt is bad. In the other currencies, nothing really happened. I guess currencies stayed relatively stable, and again, it's just at the end of the day, the dollar for now it just pulled back a little bit. So pretty much all the other currencies tried to put together a bounce. Is it any outlier? I guess maybe the Brazilian real ended the week on a positive note. And it looks like it completely reabsorbed this sharp move down. It retested the point of release in here. It was, of course, adverse pass, rejected, but it immediately reaccumulated, tested again on a Thursday, and then trying to break through, getting into the apex on a Friday, on the close. So we'll see, but, beside a few outliers, maybe one or two, at the end of the day, the rest of the currency market, it's moving as expected, right? Now, let's have a look at oil. Now, oil, it came down early in the week, as we've seen. So, Monday, Tuesday, and Wednesday was down. On Thursday, we tapped back into this previous level, right? Which, again, it's always nice to see these levels keep on playing out, although, at this point, it's a few months old. And, there were a few interactions with it previously, but still holding relevancy for now. We got the old gap, which was sustaining this entire bounce here, which now has been completely filled at this point. And we basically bounced off of these bullish fractal right here, which originated the pump. But again, nothing serious. Like we were shifting from massively bearish or massively bullish to neutral. And, over the last 2 weeks, that's what we got. Sideways market. So neutrality on this one probably was the right call. Although, don't worry, we will get to the point where we made the wrong call for the week. Absolutely. All right. Now, let's have a look instead at gold. Gold, again, it's going sideways a little bit here. It's not moving a lot. I guess, again, it's kind of in the nature of the asset. We have been talking about for ages now. It tends to have these huge runs, and then maybe it stays in a consolidation or in a range-bound environment for weeks, if not sometimes months at a time. Now, given the fact that we got a few risks, and therefore, getting back to the beginning of the video, right? Therefore, a few potential catalysts for volatility. I'm not sure if this time around is going to be one of those which stay in a range, for like 6 weeks, 8 weeks, 10 weeks, or something like it. Like, something like we've seen in here, right? I don't know if it's going to be like that. There are many different things now which could move markets around. But hey, up until a point, it goes like this. Gotta respect what the market is doing. We are still below that level, which was anticipated support. And then, of course, it was broken. And so far, again, it acted as resistance. We now have that cross of moving averages, so the 8 exponential crossing below the 21. As you can see, for now, at the very least, the market is finding resistance every time we get there. Now, before starting to be critical on moving averages, always remember that moving averages are just what? Averages. So it's natural that price will leave above and below them. Otherwise, they wouldn't be averages. They would be what? Axioms? I suck at math. I shouldn't even try to make some math terminology parallels in here. But, the point is that if you see the market rallying in here and maybe reclaiming the previous level, which is now acting as resistance, right? Naturally, the blue would cross back above the yellow again. So, it's just some sort of a short-term indication. It doesn't have to be the Bible. And there are pretty good examples, right? that sometimes you need to divorce from moving averages. They're very good in a trend. They're not good in a ranging market. Like, for instance, let's just go backward a few months. Like, take this one here, right? They crossed down right when the market was putting in the lows, right? And then the market came back up, right? It uses them as support once again, and they're crossed to the upside. They are upward sloped, but then again, the market fails at new heights. So what? Came back down. You have another negative cross right when the market is putting in the low, because it's holding up on the other relevant moving averages below. 55 should be, right? So again, when you start seeing the market going sideways, you need to have that ability. You need to be nimble and saying, you know what, we are not looking at a trending market anymore. So this is not the type of tool or edge that I want to keep on using, because, you know, I just look back in the past and I see that many different times when the context shift, when the market phase shift, well, you need to use other tools in order to assess whether the market is most likely to do A over B, right? Like, I don't know, I've been using very few indicators recently, but maybe a stochastic would be better in a ranging market. Who knows, right? So you sell the extremes on the upside, and you buy the extremes on the downside, both, you know, on the price action and the stochastic itself. So it would be a much better confirmation tool if you are in a ranging market. But yeah, so up until the point you keep on seeing this posture right here below previous anticipated support, now flipped and confirmed as resistance. Moving averages cross to the downside, although again, depending on how this price action develop, at a point, just lift your pedal from the metal when it comes down to these moving averages right here, right? But, you know, the behavior for now, it's just ranging. Now, it's not bad, right? In the sense that when you have a market going parabolic like this, right, naturally at a point it's going to pull back, or it's going to stop. The momentum is going to end, like everything. But, you know, one thing would having a blow off top, and then what? So far, we got some sort of a 11% correction, okay? So one thing would be having this blow off top and then crashing back, I don't know, 20, 25%, and getting back to the previous range, right? But overall, in the coming weeks, if this market can maintain itself at relatively high levels, compare, you know, where it's coming from, and considering how the top for now was put in, if you can see it keep on going sideways, it is actually not bad for the long term. Now I'm talking months ahead. Now, not necessarily next week. For instance, look at that. If you zoom out enough, right, what you see is that you have your parabolic moves, and then the market, you know, it pulls back, and then it goes sideways, and then you have another move to the upside. It goes sideways a little bit, and then another one. The most recent one, which originated a very long-term consolidation, it was right here, right? So not the same magnitude and not the same duration, but still same concept. Sharp move up, a little bit of a blow off, comes back down. And then it goes sideways for weeks up until the point it tries for another rally. So, you know, if you want to be long-term bullish on gold, that would be your ideal scenario. If instead we start breaking down from here, again, those same targets to the downside and potential levels for a bounce are still valid, right? So that would be gold in my view. Now, of course, you know, you might say gold, it's has been compared to Bitcoin many times, right? So, you know, let's have a look at Bitcoin instead. I'm gonna tell you, maybe you're not gonna like it, but because we broke down. So again, do you remember? It was like, yeah, swing failure of a previous high, and then, you know, you got your trend lines or your lows to the downside right here. So up until the point it doesn't break above this level or below this trend line, it's kind of, you know, just wait and see. Now, the break of the lower trend line was particularly impulsive. It happened basically on early Monday, I guess. And, since the daily close below it, the following day from the open, if you zoom in, what you see, let's go on the hourly time frame for this one, just for the sake of it, all right? So again, the break started early on Monday, right? And then it kept on going in the New York session, right? And it completely broke. And then what you had on a Tuesday, right here, starting the Asian session, and then, for me, it would be the middle of the night, maybe for the US, that would have been what? Late in the afternoon or in the evening. 6 hours difference. So 3 in the morning for me would be 9 p.m. Eastern time, right? So the market on a Tuesday tried to rally, just getting back toward the trend line, which was freshly broken, right? And, failure, and it goes down. So at the current moment in time, we just tested back into the previous level of support, which was this one right here, as you can see. Now, I think, and again, this is another one of those moments where you either be massively wrong or massively right. But, my read would be, especially looking at the past, when you hit a very irrelevant level and you establish, let's say, I don't want to say a floor, because a floor, it's more what we are looking at right here. But when you establish a dip or a key swing low, like, at this point right here, or at this point, what you want to see is immediate buying activity and a very huge reaction directionally from price action. So in this case, it drops violently, immediately is bought up, and it goes up into the other direction, right? So you have a quick reversal. Same in here, right? Or, if you look at the other tiny little range that we have in here, sharp drop, immediately bought up, goes for new highs, right? What we're looking at in here instead is that it went down impulsively, bounce, down again, bounce, and now, again, it's Saturday, so it's the weekend, but it is going sideways. For me, the way I look at markets, whether it's intraday or higher time frame, strong levels, so whether they are support or resistance, they don't usually offer up many different occasions or opportunities to be bought or to be sold. Otherwise, they wouldn't be so great, right? So the fact that we are keep on pushing these lows, I would add a little bit more on the bearish side. So eventually, I would say in the very short term, we might see 96, right? Again, can we potentially bounce, right, before then seeing it? Maybe. Yeah, that's another possibility. Absolutely. Also, because at this point, you would have some sort of an horizontal level in here. It depends where you want to draw it. Like, do you pick this one? Do you pick this one? Do you pick the clean breaking point? The clean breaking point, it's matching up with this level right here. So maybe wouldn't be a bad idea. But although, the nature of the asset is being particularly volatile, so maybe it goes for a deeper retest at this level right here. But I guess, just for the sake of it, the concept would be, is it possible to have a tiny little bounce in here early next week, maybe, and then eventually a drop into the level? Yeah, it could be. What I'm trying to say is that eventually, whether if it happens after another bounce or directly from here, I think, 96, it's a very probable price which will be offered in the near term, right? Then again, will it be Monday or will it be next Friday or in 2 weeks? I don't know. I'm just saying this is a level which would need to be retested, in my view, given the current stance of the market, right? Now, at the end of the day, whether you like it or not, the whole movement, the whole price action in Bitcoin, it kind of fit the overall tone of the market that we have seen throughout this week. Stocks kind of did the same, right? Of course, they had a completely different chart, but, we had an impulsive down move here and there. So, again, I know people like to compare it as gold. It's digital gold. Is it? I don't think it is. And again, many times, if I think back, I found myself thinking, don't really know what to think about this one. But hey, I don't know. The equity market is bullish, so I wouldn't be so bearish on Bitcoin. Or the other way around. Like, I don't know what to think about the equity market now. But Bitcoin looks weak, so maybe risk on assets will suffer or will have a little bit of weakness. And it doesn't work every single time because correlations, they tend to break in the very short term. So they can be broken in the short term, but overall, over a long enough period of time, more often than not, these markets, they do move together, which is why I keep on thinking, going to extremes. I realize that, don't take it literally, but I still think this is more like a leveraged ATF of the NASDAQ rather than a competitor to gold, right? For the scope it has, for the goals it has, and for mainly for how it's trading. Now, we can't discuss fundamentals as long as you want, but dude, it's trading like an asset, a risk on asset. It's not, unfortunately, it's not trading like gold, right? You might have the same type of returns at the end of the day, but then one could argue, yeah, I mean, everything went up. If you were in stocks, they went up. If you're in Bitcoin, overall, over the last few years, it went up massively. If you were in gold, if you look at the last 3-4 years, well, that went up too. So, I mean, again, we get back to the same talks about the everything bubble. Now, moving on to yields. Yields were very nervous this week. Again, it might be because what we have seen or what we are still looking at in the, the collateral and all the rest. But there was a sharp move to the upside on, what day was November the 5th? Was it Monday, right? No, it was Wednesday, actually. But again, a little bit of a deeper retest into these highs. But for now, at the very least, was sharply rejected. So you see that the daily candle, which went up, was immediately sold off into. Now, again, I think there is nothing really decisive in here. The market could very easily keep on being choppy for now, unless again we are gonna see developments in the repo thing and the liquidity issues and all the rest. But for me, the fact that he's spiking that much, I mean, you see people and hedge funds starting to blow out, right? You see collateral being, questioned. So I think it's natural that yields went up because think about what these dynamics imply. It implies that many different people which are trying to refinance overnight operations, right? They're not going to have access to the funds they need because, maybe the collateral that they're posting, it's not going to be taken as good and it's not going to be accepted. Or maybe they would need to pay such a higher rate that at that point, it doesn't make the whole thing convenient. Because if my financing costs are going up that much to the point that it's not covering or it's completely messing up the risk reward that I have on the other leg of the transaction, which would be, of course, taking those money and then investing them in something. So if it's not convenient, if it doesn't make sense anymore, at that point, what you're going to do, either, you liquidate both the positions, so you stop the refinancing chain, but on the other leg on the transaction, you would have to unwind the other position, right? Or, I mean, if you still think that position on the long side is valuable, but you don't have the means to finance it at that point, what you could do instead is, could you sell a bunch of treasuries, right? Because you need that liquidity short term. Yeah, you could. You call them reserve for a reason, right? And then if you sell a bunch of treasuries, what's going to happen to yields? They're going to spike to the upside. Again, spiking is a very strong terminology. It is just a day, but just for the sake of it, even if you're looking at things in the very short term, sometimes it would be easy to say on a Wednesday, look, rates are gonna definitely up. Yeah, maybe. But if you lack the overall context and what's going on overall in the broad market, you might be caught offside the very following day. So always pay attention to the entire context, right? That being said, again, they tend to move slowly, kind of like currencies. So I'm not reading a lot into this move to the upside and then quickly faded. It's still fitting the overall parameters of low rates into the future. And I think other than that, nothing drastically changed, all right? Conversely, of course, where do I have the bonds? Oh, there you go. What they did, the same, right? Down big and then up all across the board. So there's not a lot to say about that in my view. If not, that increased volatility in the treasury market and therefore yields, usually it is not a bad thing. A good thing. It's that type of market that you would like to see it moving slowly. It is boring. It moves like molasses. You don't want to see that market going high wire, right? So that would close the section, at least the first section of the charts, and we are going to move now into equities as usual. So the equity market, of course, had another bad week, right? We were coming from a drop the previous week, and we kept on dropping. Monday started out kind of going sideways, especially in ES, NASDAQ. Well, I mean, even the Dow was relatively flat in Monday London session, so, overnight session. And then, of course, as soon as the US market opened up, we had a drop, which at that time, it wasn't super huge, right? It just, we kind of tested back a little bit and then we came back down. So the potential bounce was immediately sold off. Now, we kept on drifting lower. Actually, we accelerated the move lower in the overnight session on a Tuesday. And I remember I woke up and I was like, what went on in Asia? Fuck's sake. That was a very sharp. And again, another London session, particularly choppy. We tried again to bounce and then we moved sharply lower one more time. The NASDAQ was the one which was hit the most. But again, the S&P just followed the same type of pattern. Now, on a Wednesday, we had a little bit of a bouncing attempt. And again, huge Asian move, right, to the downside, quickly bought up. London reaccumulated a little bit. It tried, as you can see in here, it tried to sell off. But again, it was bought up. So what you had next, it was a sharp move to the upside. And I think here it's where, to some degree, you could have read, a little bit of a risk into this move, into this bounce to the upside. And quite honestly, I actually noticed that in hindsight. I mean, when I noticed that, we were already dropping. We were already like in here around 25,500. So wasn't able to act upon it. But in these huge bounce that we are looking at, if you notice, NQ futures, they came right shy of the previous high. If you're looking at it from a perspective of a key swing or dip swings, right? While instead, ES managed to go above the highs, right? And that is your usual breaking correlation, which in this case tells you that, again, NQ is a bit weaker compared to the NASDAQ. And the other way around. NQ is a bit weaker compared to ES. And usually, since, NQ is the one which leads more often than not because of the weight he got from a market capitalization standpoint, that was just signal that maybe you should have been a bit cautious about the possibility of this market to keep on rallying. Little bit we know, the market opened up for New York here, basically, and we kept on pushing lower very impulsively, okay? So that was it. Now, look, the point might be that on a Friday, to be fair, the market kind of had that attempt of, some sort of a buying the dip activity. It's too early to tell, of course, if that is going to be a good low to be bought, or, if we might have another chance to buy in it. And it's probably going to be much more evident if we zoom out on a daily time frame like this. So what we're looking at is that rally where we got the breaking correlation I was talking about happened on Wednesday. So Wednesday, it's here, both for the S&P and the NASDAQ. And as you can see, we were retesting the previous highs and a previous structural level in both of them, and, to some degree, the Dow. And at the end of the day, the bounce was kind of good, right? It wasn't bad, especially intraday. Although, it was, it turned out to be just a backfill of the previous down candle on Monday. And from there, we kept on drifting. So this level, gotta say, actually failed, right? Now, again, sometimes level, they just fail. They just fail because such is the nature of things, right? Sometimes it works, sometimes it doesn't. But again, if you really want to go for the thought experiment of, okay, why it failed right this time? Well, because essentially what we got, as I hinted at in the beginning, was a little bit of a problem with liquidity, with credit, and all the rest. Now, just briefly, okay, we have been looking at this for months now, and it always seems like it's not a problem up until the point it is. Now, again, got to be very careful here because otherwise people might misunderstand what you're trying to say. All I'm saying is this. We have currently the huge old problem with the commercial real estate default rates, obviously. Then what we got was this tiny little issue in the repo market, the usage of the repo market. We had many people going to the standing repo facility at the Fed, all right, which were actually introduced right to avoid these liquidity issues, right? So, if you see a spike in that facility, it means that many people needs to go to the Fed because they cannot find the liquidity they need in the rest of the banking system, aka they don't find available lenders. So again, if you don't find available lenders, you go to the Fed, which is usually your last resort, as it should be, all right? But still, it tells that there are a little bit of stress in the liquidity markets and in the money markets, right? And, coincidentally, it was always in line with some of those, car dealers, subprime auto loans, shadow banks, and all the rest. That activity, which was a bit shady, a bit unclear, and has, as Jamie Dimon said, when there is one cockroach, probably there are more, right? Okay, so this is what we see. Now, again, it came back down a little bit, of course. Even in the past, it spiked, and it came back down, and it spiked, and it came back down. But what you need to pay attention to in this case, it's the tempo. It's the frequency at which these spikes are repeating themselves. Now, one might say, yeah, even the magnitude. I guess even the magnitude is important, yeah, but I'm more focused on the frequency, right? And, as another form of confirmation, you see the SOFR compared to the IOR, so the secure overnight funding rate against or compared to the interest on reserves, so the one that you pay at the Fed, right? These charges spiked. Okay, so again, it's another testimony of a stress in the money market. So that could be one of the issues which eventually led to this level not acting as it was supposed to. It's the infamous game of musical chairs. When the money stops, everything stops, right? So markets are driven by liquidity, of course. So you have liquidity all of a sudden evaporating. That's what you're going to get. And even in this context, at the end of the day, the level offered up a kind of tradable opportunity. Not in the S&P, maybe, as you can see, we have a very pronounced spike below it. But I mean, on the NASDAQ was great, right? To some degree on the Dow was kind of acceptable. It wasn't on the Russell. At the end of the day, I think the main risk now would be to see if this thing can actually escalate. And, if it ends up escalating, I think, again, as I said in the beginning, the Fed is already, aware of this. And again, all the things about stopping QT, dropping rates, trying to reassure the market there's nothing to be seen here. It is all because, they already know that there is actually something to be seen, or at least to be paid attention to. Now, it is dramatically huge, to put it bluntly. Is it like 2008? No, I don't think it is. As I said last week, it might be a concern, but I don't think this is yet at the scale or to the magnitude that 2008 was. So now you might ask, okay, but if, it's not the same amount, it's not the same exposure, it's not the same, quantity of nominal value at risk, okay. So then why the market, it's kind of worried so far? Because, I think the problem under many different angles is not the fact that, a few lenders went bust, right? Yeah, there were a few bad actors conducting fraudulent activity. Okay, yeah, we've seen it in the credit factoring sector, which, account receivables being posted and used as collateral, but they have been rehypothecated with 3 or 4 different lenders, right? But I don't think that's the real problem. It's not a problem of quantity. The problem, in my view, is that nobody really knows, how big this problem is. And therefore, when you don't know and you have billions at stakes, you might get to the point where maybe some institutional investors or some institutional entity, they start to have, a little bit of fear. They got cold feet, as we say. What am I talking about? It's much more evident if you're going to look at these. UBS, so another bank, obviously, they shut down one of their funds, right? And in the beginning, it was just O'Connor Fund, because, of course, it was involved with, what was that, First Brand, if I remember correctly. And at that point, you might say, well, okay, there is one bad actor. They did shady things, so they don't deserve to keep on representing the bank as a whole. They put investors' money at risk, or maybe they weren't transparent in disclosing the risks of the investments they were proponing, or maybe they were too reckless. Okay, we are shutting down the fund. Fine. Up until this point, it's fine. I mean, if not for the fact that the reason which caused them to go bust, it's a problem with collateral. But anyway, it could be something acceptable from a risk perception standpoint. But then they shut down a fund which was not affected by the bankruptcy of First Brands. And you might ask, well, okay, why then? I mean, they kept on going on like, they are prioritizing measures to protect the clients, yada, yada. Yeah, sure, why not? Of course, you're protecting the clients, as usual. And again, the most affected funds, of course, they were always designed for experienced investors. And they actually made clear the risks of the investment, right? So, yeah, obviously, especially when you look, how can you make clear the risk of an investment, right? If you are investing by lending money to a company of which you cannot assess the genuinity of the collateral it's posting, or you do not know if that same collateral can be posted with you and at the same time with 3, 4, 5 other lenders, so that in the eventuality that the company you lent money to just default on the loan, and then you need to fire sell that collateral, you show up to claim the collateral to be sold, and you find yourself in the same room with 10 other different people, and every one of them is claiming the same collateral, and they are showing contracts and papers saying that they have the claim on that collateral. You're not going to be made whole, right? So again, can you disclose the risk if you then indulge in such risky activities where it's almost impossible, given the shadiness of the entire matter, to assess the risk? So fuck off. First and foremost, then, according to them, they say that 70% of the fund, can actually be monetized. So wait, they are taking a 30% haircut? Do you call it risk management? Like putting like a 1/3 almost of your net worth as a fund into something? I mean, the way they are trying to justify it, I think this is right why people go a little bit worried, all right? And again, this is the final conclusion. In the industry, it just takes a concern, all right? And if you start thinking about bad debt, bad collateral, and the fact that many of those loans are used to are securitized and then used as collateral for financial transactions, you're basically throwing a dent in the trust, in the bedrock of the financial system at this point. So the thing is that when you start seeing something like that, and if, as they say, these funds were designed for experienced investors, now put yourself in the shoes of an experienced investor, right? When he sees that you're actually shutting down a fund, at that point, okay, but then you shut down another fund, which is not related to the entire rotten thing. The thing is that the experienced investor is going to look at that and saying, hey, why are they shutting down the other one too if it wasn't affected? You know what? What would I have been doing if I wasn't there? Imagine I would have said, you know what? I don't care if it's not affected. I already lost money on the other one, so I need to be made whole, and I need to liquidate this one, which is still in profit. Just for once, just to name one. Or again, well, but I remember Jamie Dimon said that if there is one cockroach, probably there are going to be plenty. So you know what? In order to be safe, can you give me back my money so I'm sure that I'm safe, right? It's a matter of the dimensions. If you start to have many different requests for money back because investors all of a sudden, since they're experienced, as you said, they become so not, their appetite for risk goes lower and lower and lower. They want to get their money back. If they want to have their money back, what are you going to do? I mean, it's a fund, so you will need to liquidate the fund in order to give them the money back. And then, other people seeing those investors claiming and pretending their money, and demanding their money back, and they might say, I wonder why these guys are all scrambling to get their money back from this fund. And I mean, it snowballs from there, right? It's just, sometimes it's not just about the default risk of something, right? Sure, it is a metric that you should always take into account, but sometimes what can get to you, it's the liquidity risk. AKA, look, eventually this might be a complete nothing burger, right? The funds were safe, the rest of the collateral was actually healthy, there was no risk at all, but the perception at the moment, it was that it wasn't safe, or at least, big problem, there was some sort of an information asymmetry. You didn't have the information for sure that, there were many cockroaches, but just the fact that you didn't know how many cockroaches there were leads you to actually exit the market. It's the same principle of a bank run at the end of the day. So I think that played a role, and we have seen people being forced to kind of exit positions and sells and all the rest. So that could have been the catalyst to explain why eventually this level failed. Now you might say, yeah, it's easy to say now. We basically have all the news now. Yeah, but again, it would be also hard to do it. Like at the end of the day, saying that this level would have failed without any reason would have been like what? I mean, it's an uptrend, right? So you expect level to hold. Of course, sometimes you won't, like in this case, and then you just go back and say, I wonder why it didn't work. Like, I mean, it's just one of those things that you do in order to say, was it my strategy which was flawed, or there was some sort of an exogenous event which led to this spike in volatility and kind of short-term panic in the market? So that could be one reason, right? I think, at least for this week, the main reason. Now, of course, you might have many different ones, right? I'm not saying this is the one and only there is, but, it could be just one. Now, let's get back to the technicals a little bit. So, all in all, right? Just remember, although you might expect that level to hold, right? Last week, what we said, that, there were many different divergences print, all right? Momentum indicators were turning down. The stochastic was the MACD was turning down as well. So, it's not like there weren't risks identifiable, even from, a technical standpoint. Now, I guess at the end of the day, as you can see, the market put together kind of a strong bounce on a Friday, and it came in the second part of the day, and it accelerated in the last hours of the day, which, sometimes it can indicate institutional buying activity. The problem is that you need to assess now if this is a structural break or if it's not. I think it's not yet, because I think many different people would look at this trend line and saying, well, at the end of the day, we held the previous levels, or at least, the previous trend line. So, I mean, yeah, same scare that I got in the past, like in here, what was that? August, then again in September, and then most recently in October. And at the end of the day, it always resolved itself to the upside. So, yeah, let's buy the dip one more time up until it works, right? And you get back into the giant mindless robot, the passive investing, and all the rest. Plus, but they are going to start buybacks. We are almost through earnings season. So, yeah. Plus, seasonality is still on my side. So maybe I do want to buy this dip as well. So again, there are reasons to actually buy this dip. In the mind of the, broad public, I think. And again, if you put yourself in the shoes of a few institutionals or money managers which were underweight stocks compared to, let's say, the retail counterparties, as we have been discussing in the past, again, that could be a reason or an opportunity to add exposure and then trying to ride this rally into the end of the year. So, I mean, if you want to keep on being bull, right, the bullish narrative has a lot to offer. But again, at the same time, the bearish narrative has a lot to offer. So it's always a matter of waiting out the different components of the two narratives and see who's going to win in the end. I say again, if you zoom out a bit, what you see is that in the most recent times, nothing. I mean, it's particularly close, but yet nothing changed. Right? We have been here for many different times, right? We had a few tests toward the 21 exponential, a few deeper tests towards the 55, as you can see, but the trend has always remained intact. The only risk in the short term for now would be that as we were in the past, we are kind of close now to trigger a cross of the blue below the yellow. We were super close, especially if you look at NQ, back in September. Eventually it didn't happen. So, the market was safe then. and it kept on rallying for another 2 months. So again, could this be different this time? Yeah, it can always be different. I'm just saying, before shifting to bearish in the sense of being bearish for the next few months, I would wait for a bit more, a bit more of a substantial type of signal, right? So again, just pay attention to it. I think, again, we are at some sort of a sliding door type of moment for the very short term, not talking next year or whatever, just short term, right? If you see this cross happening, as we've seen in gold, then you might need to shift your bias from massively bullish into the end of the year to maybe neutral, right? So again, this might be one of those moments where when you wake up in another 3, 4, 5 days and you say, well, yeah, I guess that was it. Now the market, it dropped, I don't know, another 200 points. So now I really need to be super defensive, right? But again, up until the point it doesn't happen, it's something that you can pay attention to, but especially if you're in for the long term, making huge and drastic changes to your portfolio structure for a very short-term movement in the market, I guess it's not necessarily the best thing to do. So I would say just wait and see. I think it's totally possible that next week we might try to extend this rally, because if you check the heat map for a minute, what you see is that there is a lot of red, obviously, but look at where the majority of the red is. Of course, Nvidia, Apple, Microsoft, Google, it's not really that down. Meta, Oracle, Palantir, Broadcom, Amazon slightly down, Tesla. Well, Tesla, Tesla, it's a different beast. I think this is the first time ever that you see a company, or the shareholders actually accepting or allowing the CEO to get 1 trillion in salary. But yeah, I mean, that's the way it is. There is still the whole narrative about these AI stocks with the profit recycling, all these I finance you, then you buy my stuff, and all the rest that we have seen going around in between Nvidia and OpenAI, and now involving all the rest like CoreWeave, Palantir, of course, Microsoft, Apple. Apple, I don't know if they're really involved. I think they're trying to develop their own, if I'm not mistaken. But again, so what was that? Is it vendor financing, which would be kind of legal and legit, I guess? Or, it's straight out fraud, as we were saying throughout the .com, where basically there was no exchange of goods or payments. They were just invoicing one another in order to boost up the revenues, although there was nothing substantial below it. And the SEC actually, at the end of the day, stepped in and sanctioned those companies doing that. I mean, I don't know, honestly. It's just another thing which kind of tells you that, we are reaching into levels which are particularly extreme. So as I said, there are arguments for both the bearish and the bullish argument here. But if you just look at the price action, I think we are not that fucked for now. And again, this might end up being just a simple rotation. You got stocks in the index, like again, these ones, the AI, of course, right? Which were massively overbought. And so, they were sold off a bit, and the money rotated into other sectors of the index. So, for instance, let's have a look at these, right? Over the last 5 days, right, what you see is that communications, consumer discretionary, and what else? Oh, of course, technology, massively down. But look, staples, financials, healthcare, right? Real estate, energy. I mean, they were up. So this is not a broad downturn. It's not like the entire market, it's coming down. sure, the index it's coming down because those sectors which are representing the majority of the index by market capitalization came down a lot. But it's not like those money, for instance, they got out of the stock market and they went completely, I don't know, into treasuries. Because otherwise, this chart for this week, it would look a hell of a lot different, right? So again, I think we need to just, keep our cool and keep assessing things on a week-by-week basis, right? Especially because if you zoom out these two charts, right, on a weekly time frame, right, using the same parameters, right, is it the first time that you see a weekly candle coming back down, testing around this fast moving average, which now would be the 8 exponential moving average on the weekly, which have been governing the entire rally since basically the April lows were put in? We got back to like 1 at the very beginning, then almost 2 times, and of course 3 with these weekly open here, then 4, counted as a 5, 6, 7. So again, if you're looking at it for the long term, I think, nothing really changed. It's like the ebbs and flows of the market. So I would just maintain a little bit of a cautious approach as usual, because you want to be nimble in these times. But at the same time, don't get ahead of yourself with all the bearish headlines. And again, if next week you're going to see the market breaking the trend line and starting to trade below even the 55 exponential moving average, the momentum is going to be shifted completely, then, you're going to say, yeah, I guess, something really changed. How much in terms of opportunity cost or in terms of realized profit did you give away if it happens? Let's say 5%, right? Okay, and then you start to the risk before maybe you end up losing a bit more, like another 6, 8, 7, 8%, right? But I guess, you have to balance out the risk of giving back profits to the risk, or with the risk of losing opportunity. Because imagine puking these lows right in here, right? Then a few days after that, you see the market being up 5%. What are you going to do, right? If you are so impulsive, the risk is basically this. You puke these lows, and then the market says goodbye and it keeps on rallying. And then you say, I was such a bitch for puking the lows. You know what? I'm going to buy the breakout now if it breaks out. Yeah, so you buy the breakout, it gaps up, you buy in here, and after a week, you're basically down this, which is nothing for now, it's 2%. But again, at this point, you start to question, wait, did I just form it in and I bought the top? Maybe I should sell now. And maybe you sell here, and the market keeps on going, at least for a retest of the highs. So I'm just saying, nobody knows the future, but just stay calm many different times. Your ability to maintain your cool when everyone else is losing it, it might save you like a lot in terms of money and even in terms of wealth. So you're not continuously stressed over things, right? You need to sleep well at night. If you're not sleeping well, I guess the simple answer is not where the market is going, but you have probably taken on too much risk for what your psychology or your brain can actually handle. So that would be it. Now, again, closing in with this, at the beginning of the week, let's just have a look at the positioning. It's not updated because this was at the beginning of the week, to be fair. But, we were at extremes. And I guess, again, maybe there were a few short-term CTAs which were already sniffing something. Because if you look, sentiment indicator was kind of down. Not a lot, but kind of down a little bit. And yeah, here's where you see the systematic strategy, which was particularly elevated, but they started selling the week ahead. So I think, from a positioning standpoint, we weren't really at extremes, but, nonetheless, on the high side of the range. I mean, 82% on systematic, although again, discretionary, just 52 percentile. I mean, these are not usually figures which precede huge crashes in markets. At least, the way I see it. I could be wrong, of course, as usual, but, then what we see, this is about breadth. I mean, if you want to check the stocks above the moving averages, right? Like your 150, 75, 50 simple moving averages, and you see they were declining. So again, the breadth of the market was just tapering off. Then you got other indicators like your count of overbought versus oversold, and sentiment historically, which was particularly high, the buy strong or sell ratio. So I mean, as we looked at in the past, there were many different things telling you that the rally was getting a bit ahead of itself, even by, as we said, by just looking at simple moving averages, right, being particularly deviated, and therefore again the market tends to gravitate back towards them sooner or later, right? This should be, I don't remember if it is actual performance is as for the price change, but should be that. Again, you see the Mac 7 and the Nasdaq just leading the charge. But the S&P without the Mac 7 and the S&P in general was really struggling, right? So again, concentration, breadth problems, and all the rest. Now, throughout this week, we got, a lot of institutionals were actually net sellers, which, again, it's a little bit of a, which one of the two would you pick? Like, again, because as I said, if I am underweighted stocks, this might be a good opportunity to load up, right? But at the same time, Bank of America is telling you that the majority of people selling were institutional. Of course, retail was buying, obviously, right? At least, last week, because as you can see, from 27th of October to the 31st, so I would be curious to see what happened this week, the first week of November with this further drop. Probably it might be slightly different next time. But institutional were selling. Why? Again, could this get back to the same thing about UBS? The two funds closed, the shutdown, the liquidity issues, and all the rest. Maybe the information asymmetry. You know what? I see something wrong here. I see something which really doesn't add up, but I can't quantify. I can't assess the risk. So just in case, let's de-risk a little bit, aka let's sell something. And let's bank in the profits, or let's hedge or whatever. And, that's what you got. Now, here's an interesting statistics, which again, we are pretty early in the month. It's just the 8th, right? So the first trading week of November just went on. But with the perspective of the entirety of the month, this is kind of nice. In the sense that these are basically monthly gains, aka monthly candles, which closed negatively or positively, or green or red, if you want to call it that. Now, what you see is that we are basically getting through 6 consecutive monthly candles, right, in a row. Now, it is true that at this level, usually you see a drawback or a pullback or whatever, a drawdown or slightly correction. Okay. The point would be another one though. Although it's true that these signal extreme conditions in the market, if you look at it from a statistical standpoint, right, we got to the 6 months how many times? 1, 2, 3, of course, past and beyond that, 4, 5, and then we are in for a 6. For a 6th. The funny thing is, and again, we don't know how November will end up, but out of the previous 5 times, getting back to 2009, right, the only one time when we stopped at 6 months consecutive green candles was this one in 2018. All the other times, yes, the market was overextended. The market was getting ahead of itself. But if you check, we went up for another month. So we got up to 7 months before an actual correction. Here, of course, here we got up to 10 months. And then even in here, right? So again, just because the market is overextended, same old rules. You don't know how much irrational the market could go, right, before finally dropping. And again, it's just statistics, all right? So this is not the Bible. You shouldn't take it literally. It is just, I guess something to consider at the end of the day. And then we'll see what's going to happen. But, for now, obviously, the month, it's negative. But, as I said, it's still a long month, right? Now, imagine being massively bearish at the NASDAQ in April when the price action was here, right? I mean, and then it closes like this, actually closes positive, and it goes up for a huge rally. So again, it's nothing really useful in the very short term, but, we'll see when we get back in, when we get into December, how this monthly candle actually closed. Now, from here to the recent lows on NQ, getting back to the highs would be what? A 6% rally in 3 weeks. I mean, I've seen many crazier things in the NASDAQ. For the ES futures, from the lows up to the highs would be a 4.5% rally. And you got 3 weeks for that. So again, I think, nothing is a foregone conclusion. Same as for the rate cut in December. There are still a lot of things which could go on. And another thing which could go on to closing this entire thing right here is that, we are now having the Supreme Court, which needs to decide if these tariffs are actually legit, standing to the Constitution, or not. Polymarket right now, it's pricing in very poor odds of the Supreme Court to rule in favor of Trump tariffs. Now, I guess, it's not going to come as a surprise to those which lives in the US, of course. But for those which are not living in the US, I guess it might be the same in your own country, like, for instance, it is in mine. But when it comes down to impose new taxes, since tariff is a tax at the end of the day, that is a prerogative that only the Congress has, right? And for instance, in my state, it would be the parliament, right? The Italian parliament, all right? You Yanks, you got the Congress. So the problem is that those tariffs were implemented by an executive order by the president. So it's like, can he do it, right? Or should he go through Congress, and then if the Congress decides so, then we are going to impose tariffs. Now, this could be important, not only because, look, that was the roadmap, the impact on revenues for coming off from tariffs for, basically 2026 up until 2035. So another 10 years. And we're talking about billions, by the way. So, I mean, it's not a tiny bit over a decade. It's kind of a lot. So first of all, if eventually the court actually rules against Trump, you might ask, okay, so what about the deficit at this point that we need to write off all these potential future revenues, first of all? Then it could create maybe a little bit of a liquidity issue, in the sense that if they are unconstitutional, what's going to happen to all the revenues that we already collected? Should we just give those money back to those people which actually paid that? which could be whether it is a foreign country or most likely the local importer, right? So I mean, that could really end up badly for. I mean, not for Trump himself. I mean, surely he wouldn't like it, but it could really be a problem overall, because again, as we said, if this money by the government are not spent in the real economy, there is less liquidity available, right? And aggregate demand, it's not supported. So just imagine, I mean, if you like conspiracy theories, right? Could it be, the government shutdown is actually the main reason why this money are not spent for now? But who would tell you that even if the government opens back up, they're not going to immediately spend this money up until the point they don't have this matter sorted out? Because then if they have to refund all the tariffs collected so far, maybe a portion of the drop you're going to see in this chart, it's going to be due to those refunds instead of putting money in the private sector and in the private economy. So again, just to add to the gazillions of risks out there for markets. Now, that being said, I'm going to cut you off here, or cut myself off, should I say. Enjoy the rest of the weekend, and as usual, as every other week, be nice and be cool. We'll talk again next week. Niels out.
So, what you're telling me is that the music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.